Hello, this is Henry of AutoAnalysis. Welcome to the July 2013 edition of the European Car and Light Commercial Vehicle Production Outlook briefing video from the SMMT. Let's have a look at what happened last year in 2012. Production in Europe, including Russia, was at 18.1 million in 2012, which is about a million down on the volumes of 2011. Excluding Russia, Europe was at 16.6 million, which is approximately 1.8 million down. In fact, a complete collapse in European production was prevented by some modest growth in the Czech Republic, Hungary and Romania, and strong growth in Slovakia and the UK. The main losers in 2012 in production terms were Italy at 120,000 down, France at nearly 250,000 down, Spain at just over 400,000 down, and even Germany, which lost nearly 500,000 units. And German loss was due to the severe decline at Ford and Opel and the model cycle effects of new models coming in at Mercedes, Audi and VW. What do we see in terms of the recovery of production in Europe? Well, Germany will certainly recover, and by 2017 it will be back above its 2007 level, but we don't see it getting back to its 2011 peaks. In the long term, there will be losers, with France down approximately a quarter or 750,000 on its 2007 volumes, and that even allows for Renault's renewed commitment to French production. Italy will be down around 20% at 240,000 units, Spain down around 15% by about 400,000 units on its 2007 volumes, and that even allows for the Fiat reorganising its production in Italy and Renault's proposed expansion in Spain. We will see a continued eastward shift of production, and in the period 2012 to 2017 the Czech Republic should rise around 12%, Hungary will almost double, Romania will grow by a quarter, and Slovakia by another 13% or so. And indeed the UK's production is still growing, and in fact between 2012 and 2017, assuming Mini, JLR and Nissan fulfill the expectations which we have, we can see UK production growing by around a third, reaching over 2 million units a year. In this chart we can see the growth in European car and LCV production by country between 2007 and 2017. And then approximately in the middle of each bar we can see the green colour which signifies the growth of Russia. We can also see the clear and continuing dominance of Germany, which is the blue towards the bottom. In fact, including Russia, it looks as though the market recovers reasonably well from 2014 onwards. However, the reality, that is without Russia, is somewhat different. Taking Russia out of the picture, it's somewhat less attractive. Whereas total production in Europe is expected to get back to around 23 million, including Russia. Excluding Russia, it doesn't get back even to 21 million by 2017, according to our base outlook scenario. And in fact, Europe will take until 2017 to recover to the 2007 volumes. This is 1 year later than we projected earlier in the year. We also include some scenarios here which show what would happen if the markets in different countries will be down by between 1 and 5% lower than any fall or modest recovery inherent in our base outlook. However, it is possible, indeed it's probable, that the situation could be much worse if the decline in European production and sales continues. And this chart shows some alternative scenarios. We have at the top, in the blue line, the base outlook. The pink line just below that is the base outlook without Russia. And the widening gap between the blue and the pink lines highlights the importance of Russia to the total production volumes in Europe. What happens if we have a continued fall in European production this year and indeed next year? Well, this is shown in the yellow and then the purple and the turquoise lines below. A continued fall in 2013 would mean that the resultant best case scenario, which is the yellow in 2016, would only be slightly better than 2008, and this raises the issue of Europe not fully recovering to its 2007 peaks until well after that, if at all. A further decline in 2014 will not only delay the long-term recovery in Europe, but also raise the issue of the market settling down to a much reduced level. Europe needs to consider the implications of what would happen if scenarios 5 or 6 came to pass. And in fact, if long-run European production, excluding Russia, is below 17.5 million, or indeed worse, at around 16 million, as in scenario 6, we don't believe that the current industry structure is any longer sustainable. So what has been the reaction of the vehicle manufacturers to the changes in car production and sales here in Europe? Well, we have seen European car markets falling in 2012. They fell to a 17-year low, and in fact this has continued through January to May 2013, where the figures have showed continued decline, with limited signs of recovery across Europe, the UK excepted. UK continues to grow. Sales decline has hit the volume vehicle manufacturers very badly, and their production totals have fallen between 2007 and 2012. The volume companies, that's Fiat, Ford, Opel, Vauxhall, PSA and Renault, each lost around 500,000 units or more, a total of 3 million units production. and during the same period, total European production fell by around 2.1 million, with the major winners in that period being Dacia, Hyundai, Kia, Nissan, and the VW Group. This is suggesting that there is a new order for the vehicle manufacturers beginning to emerge in Europe. We see the traditional volume brands facing long-run structural decline across Europe as the value brands and the premium marques grow. And having lost more than 500,000 units each over the past 6 years, we do ask the question once again, can the volume VMs ever really recover to their past glories? Restructuring and refocusing is now underway amongst most of the vehicle companies, particularly the volume companies. Faced with continued and rising losses, Ford, GM and PSA have announced plant closures and reorganized their manufacturing footprints. Fiat isn't closing plants, it's reallocating production between its Italian factories. It's slimming down but not closing plants. It's bringing back production from Mexico to Poland, and it has announced ambitious plans to use its European factories as global export bases for Fiat, Alfa and Jeep, including exporting to the States from both Serbia and Turkey. Renault has reached agreement with its unions on cost-cutting, and it's increasing its commitment to French and Spanish vehicle production, including adding car production of Nissans to its European portfolio, in fact in France. GM and PSA have also established a defensive alliance which covers logistics, purchasing and new model development, although the benefits from these, especially new models, will not be apparent until 2016-17. So will further cuts be required if demand and production continues to fall? We think it in fact highly likely that both Fiat and Renault will need to cut further into their fixed cost base, and who knows, the others may need to as well. Is there potential for export markets to come to Europe's rescue and be its saviour? In recent years, the German and UK premium and luxury brands have been very dependent on US and Chinese demand to maintain production volumes. To date, these markets have held up reasonably well, but we do ask whether non-EU export demand can sustain European production in perpetuity. This option is not really available for the volume brands. VW, Fiat, PSA, BMW and Mercedes are all increasing capacity outside of Europe, especially in North America, Brazil and China. For example, VW is increasing production in Mexico, Audi is building a new plant in Mexico, BMW is widening its US production portfolio, and it's building a plant in Brazil. VW, PSA and BMW have all announced new or expanded Chinese plants in 2013. And some of the moves in terms of building plants outside of Europe can actually harm struggling European production sites. For example, will Renault Dacia production in Morocco actually impact on its European factory output? Labour problems in Romania could accelerate the switch in production to Morocco, and Renault's own entry models made in Europe will certainly be undercut by Dacia's and possibly Renault's made in Morocco and imported into Europe. So, in conclusion, we see the sustained recovery in Europe in terms of production, excluding Russia, unlikely to occur before 2014, and quite probably any real increase will be in 2015 and beyond. And when the recovery does come, it will be shallower and slower than post-2008-9. It's increasingly likely that long-run European production volumes will be well below their 2007-8 peaks, and the implication of this has not been fully worked out by the European vehicle companies. European vehicle production was actually financially weak even in the boom times, and we wonder how much longer can the VMs continue to support their European operations if losses continue. We've already seen Ford, GM and PSA cutting back their European operations, and while GM and Renault are committed to their existing operations, we wonder whether such moves are sustainable in the long term. Further restructuring capacity cutbacks will almost certainly be required. The question is when and where. And while we ponder on the future of the traditional volume brands in Europe, we should remember the rising strength of the Koreans and Nissan and the enduring appeal of the German and UK premium brands. This should not be underestimated. The pressure on the volume brands will increase, and it will be impossible to ignore. We still think it's highly likely that a major European name could disappear by the end of the decade. Thank you for listening. Details of how to access the report are now shown on the screen. Until next time, goodbye and thank you.